When price spikes upward with strong momentum, many traders panic. Some miss the move entirely, while others are overwhelmed by the fear of missing out. But the truth is, price does not move randomly. Every sudden spike has a cause, and if you understand that cause, you stop chasing price and start positioning before the move happens. There are 5 major drivers of price spikes: liquidity, imbalance, institutional involvement, order blocks, hedging, and news. Sometimes one of them is enough to move the market, and other times they work together to create explosive momentum. In this video, we focus on one powerful factor, and as you continue following my content, you will gradually uncover the rest. Subscribing and following my videos could be the step that leads you to the one lesson that will make you consistently profitable. Don't miss it. Show support, hit subscribe, and let's get started. So stay with me as we break down one of the most misunderstood concepts in trading, the order block. Our understanding of order blocks has evolved over time. Traditionally, it was defined as the last bullish candle before a move downward and a formation of fair value gap, especially after liquidity is taken and the market shifts structure. But the market is dynamic, and if you study price behavior deeply, you begin to see something more important than a single candle. You begin to see a process. An order block is not just a candle. It is the footprint of institutional execution at a specific level, and that footprint is formed through a sequence of events, not a single moment. Now look closely at the chart. Before the strong displacement move, price forms a small consolidation. That is not random. That is where institutions are active. This phase represents compression, where opposing pressure builds and liquidity is engineered. During this process, liquidity is often taken, and price becomes tightly packed. Momentum is quietly building beneath the surface. Then suddenly, expansion, a strong displacement move, breaks out, leaving behind imbalance. That is your confirmation that something significant just happened. Think of it like a compressed spring. The tighter the compression, the stronger the release. That compression phase is the true institutional footprint, not just one candle, but a behavioral pattern. Why is this important? Because price often revisits these zones, not by coincidence, but to rebalance inefficiencies and interact with remaining liquidity before continuing its move. When you understand this, you stop reacting to spikes and start anticipating them. So instead of viewing order blocks as a single candle, begin to see them as a process, a story of accumulation, manipulation, and expansion, a footprint that reveals intent. However, not every consolidation is an order block, and not every order block will lead to a reaction. This is why confluence is key. You must combine multiple factors to increase probability and avoid false setups. What factors? Stay with me as I reveal them. High probability setups typically form after liquidity is taken and market structure shifts, in confluence with a higher time frame bias. Higher time frame bias is not what makes an order block valid, but it is what makes it reliable. When your setup aligns with the higher time frame direction, you are no longer trading just a reaction, you are trading continuation. That is what defines a valid institutional footprint. Stay connected, because what comes next will change the way you see the market forever.